So, I want you to imagine for a second that you are 85 years old.
Okay, 85.
Right. And you've done literally everything right in your life. I mean, you worked really hard, you saved aggressively, you invested in this perfectly diversified portfolio, and you successfully retired.
You're living the dream, basically.
Exactly. You're sitting on a nest egg of, let's just say, $800,000. You feel totally secure. But then your health begins to decline.
Which is, unfortunately, just a reality of aging.
Yeah. And it gets to the point where you require full-time memory care. And within 3 years, just 3 years, that specialized facility completely wipes out your entire $800,000 life savings.
Oh, wow. So it's just gone.
Completely gone. You are left with absolutely nothing to pass down to your children.
Yeah, it is the ultimate terrifying paradox of modern medicine.
How so?
Well, we have engineered the human body to survive longer than ever before, right? But we haven't adequately engineered the average financial portfolio to actually support that survival.
Right. It's like you survive, but you go completely broke doing it.
Exactly.
So what if I told you that the life insurance industry saw this exact demographic cliff coming, and over the last few years, they quietly but completely redesigned how we interact with money to prevent it?
That is exactly our mission for this deep dive.
It really is. We are looking at this massive stack of industry analysis, market trend reports, and actuarial data that defines the 2026 financial landscape.
And specifically, we are decoding this massive shift toward hybrid financial products.
Because, life insurance is no longer this dusty stack of morbid paperwork just sitting in a filing cabinet next to your birth certificate. It has fundamentally evolved.
It really has.
So whether you are prepping your own financial portfolio or you're just insanely curious about how a historically slow-moving trillion-dollar industry adapts to modern crises, this deep dive is your shortcut to understanding the new era of life insurance.
And wealth management as a whole, really.
Right. Okay, let's unpack this. We are looking at a complete paradigm shift here.
We are. And, what's fascinating here is that life insurance has effectively transformed from this single-purpose binary safety net.
Where it just sits there doing nothing until you pass away.
Exactly. It's transformed from that into this multidimensional financial Swiss Army knife.
A Swiss Army knife. I like that.
Yeah, because it combines protection, investing, retirement planning, and healthcare. And the driving force isn't just like a clever marketing gimmick to sell more policies.
It's deeper than that.
Much deeper. It's a reaction to sheer economic reality. Longer life expectancies, sky-high healthcare costs, and increasing financial complexity.
So they were basically forced to adapt.
Completely. This historically slow-moving industry had to rapidly innovate. They had to build products that actively combine death protection, investment growth, retirement income planning, and healthcare coverage all into one single ecosystem.
A financial Swiss Army knife is literally the perfect framing for this.
But
before we start pulling out the corkscrews and the tiny scissors...
the complex new tools, right?
Yeah, the complex stuff. Before we get to that, we really need to understand the main blade. You can't appreciate the multi-tool if you don't get the base layers.
That makes total sense.
So, based on our sources, the industry breaks traditional coverage down into two primary categories: term life insurance and whole life insurance.
The classics.
The classics, exactly. Let's start with term, because I think this is the one most people are actually familiar with it. You are essentially renting coverage for a specific fixed period of time.
Right, like 10, 20, or maybe 30 years.
Yeah. So, outline the benefits of this for us.
Well, the core advantages are that it's affordable, it's very straightforward, and it provides transparent income protection during your working years.
Okay, so if you pass away during that specific time frame, your beneficiaries receive a tax-free lump sum.
Exactly. But there are major limitations. If you outlive the term, the policy simply expires.
Contract is just over.
Over. There is absolutely no lingering financial value.
Which means there's no wealth accumulation whatsoever.
None at all.
So, if I pay into a 20-year term policy and I live for 21 years...
the money you paid in premiums is just gone.
Wow. You don't get a refund for surviving.
No, you don't. It functions exactly like your auto insurance. You don't call up your car insurance company after a decade of safe driving and ask for your premiums back just because you never crashed your car.
Right, that would be ridiculous.
Exactly. You paid for the transfer of risk. That is the fundamental trade-off for the affordability of term life.
Because it is incredibly cheap.
Very cheap. Because insurance companies possess these massive actuarial tables, They know with absolute mathematical certainty that the vast majority of people will statistically outlive their term policies.
So they rarely actually have to pay out the death benefit.
Right. And because of that, they can offer massive coverage amounts for relatively tiny monthly premiums.
Let's put some real numbers to that so we can, anchor this concept. A healthy 30-year-old might be able to secure a $1 million 20-year term policy for something like $30 or $40 a month.
Which is basically the cost of a few streaming subscriptions.
Yeah, it's incredibly cheap. It provides that transparent income protection for your family during your peak earning years when you likely have a mortgage and young kids.
Exactly.
So with all these crazy new hybrid tools available in 2026, what is term's modern use case? Is it obsolete?
Oh, not at all. Actually, term life is increasingly being utilized strictly as the foundational base layer.
The base layer.
Yeah. Modern financial planners don't view it as the only solution anymore. You secure that catastrophic risk with a cheap term policy to replace your income while you're working.
Okay, so you lock down the worst case scenario.
Right. And then once that massive liability is covered, you start stacking other permanent financial products on top of it.
Okay, so term is basically the concrete slab of the financial house.
That's a great way to put it.
Which brings us to the other traditional building block. And this one is like the complete opposite in terms of structure. Whole life insurance.
Yes, whole life.
Yeah.
Permanent option.
So the sources highlight the traditional strengths here. Guaranteed cash value growth, fixed premiums, and lifetime coverage. It never expires as long as you pay the premiums.
Right. You are covered until the day you die.
But here is the major friction point. A 30-year-old paying $30 a month for a $1 million term policy might look at a $1 million whole life policy and see a premium of like $1,000 a month.
Oh, yeah. It is a massive price jump.
It's huge. So where exactly is all that extra money going? What are the risks or limitations here?
Well, the limitation is obviously the higher cost and the rigid structure compared to term. But let's use a mortgage analogy to explain the mechanics underneath the hood.
Okay, I like analogies.
When you buy term insurance, you are essentially renting.
Yeah.
When you buy whole life, you are buying equity.
So I'm building value in the policy.
Exactly. Because whole life is permanent, the insurance company knows they are contractually obligated to eventually pay out that $1 million death benefit.
Because eventually everybody dies.
Right. Whether you die tomorrow at age 31 or decades from now at age 99, they have to pay. So to fund that inevitable payout, they have to charge you significantly more upfront.
Okay, that makes mathematical sense.
So your premium is actually split. A portion goes toward the actual cost of insuring your life, which naturally gets more expensive as you age, and the rest goes into a high-yield savings reserve.
And that's what they call the cash value.
Exactly. That is the cash value.
So in the early years of the policy, I am massively overpaying for the actual statistical risk of dying, and that overpayment is building up my equity.
Yes. The insurance company takes that cash value, they pool it with billions of dollars from other policyholders, and they invest it.
In the stock market.
No, primarily in highly conservative long-term corporate and government bonds. They then credit your policy with a guaranteed annual dividend based on the performance of those bonds.
Okay, so it's very safe.
Very safe. Over decades, that cash value grows predictably on a guaranteed curve, insulated entirely from the volatility of the stock market.
All right, I have to push back here. I really do.
Go for it.
Because this is the classic personal finance debate, right? The math on whole life has been debated for decades.
Oh, absolutely.
The prevailing wisdom for a very long time has been buy term and invest the difference.
The golden rule of the 90s and 2000s.
Exactly. If term is so incredibly simple and cheap, why complicate things? Why not just buy that $30 a month policy, take the remaining $970 you would have spent on whole life, and dump it straight into an S&P 500 index fund?
It's a very logical question.
I mean, historically, the stock market yields around, 8 to 10% over the long haul. A whole life policy's internal rate of return might only be 4 or 5%. Why would anyone willingly lock up their capital for a lower return?
It's a brilliant challenge, and on a purely mathematical spreadsheet projecting forward 30 years in a vacuum, buy term and invest the rest almost always wins.
Right. The math is the math.
But human beings don't live on spreadsheets, and markets don't operate in vacuums. There are two critical flaws in the buy-term philosophy that modern planners are actively solving for.
Okay, what's the first law?
The first is behavioral. Statistics consistently show that the vast majority of people simply do not have the ironclad discipline to actually invest that difference every single month, without fail, for 30 years.
Oh, yeah, that's true.
They buy the cheap term policy, which is great,
Mhm.
but then they spend the difference on a nicer car or vacation or just daily living expenses.
Fair point. Life gets expensive, and, the index fund contribution is usually the very first thing to get paused when the furnace breaks.
Exactly, it forces discipline. But the second flaw is even more critical. It's the sequence of returns risks.
Sequence of returns. Explain that.
So, the stock market is an incredible engine for growth, but it is deeply volatile. Let's say you follow the buy term strategy perfectly. You build up a massive stock portfolio over your career. Then you retire at age 65. What happens if, in your first 2 years of retirement, the stock market crashes by 30%, like we saw in 2008, or the massive contraction in 2022?
That would be brutal.
It is. If you are forced to sell your stocks to pay for your living expenses while the market is down, you permanently lock in those losses.
Because you have to sell more shares just to get the same amount of cash?
Exactly. Your portfolio might literally never recover from that early hit.
You are cannibalizing your own nest egg at the worst possible time.
Precisely. And this is exactly why planners are repositioning whole life today. They aren't selling it as an investment to beat the stock market anymore.
How are they positioning it then?
They are utilizing it as a highly stable, conservative asset class within a much broader, diversified financial strategy.
Oh, like bonds or fixed income investments.
Exactly like that. It provides a necessary anchor of stability that term alone simply cannot offer. You don't buy bonds for exclusive growth. You buy them to act as an anchor.
So when the stock market tanks, the cash value in your whole life policy doesn't drop a single cent.
Not a penny. It keeps compounding at its guaranteed rate. So during a market crash, instead of selling your deflated stocks, you can just draw tax-free income from your whole life cash value.
Which allows your stock portfolio the time it needs to actually recover.
Exactly. It's a volatility buffer.
Okay, that reframes it entirely for me. It's not about maximizing every single dollar for top-line growth. It is about engineering certainty into an inherently uncertain financial world.
Which is incredibly valuable in retirement.
So we have our foundational tools. We have term for pure, affordable protection and whole life for permanent, stable, bond-like anchoring. We've built a solid financial house.
What?
But as we move out of the accumulation phase of life, we run headfirst into the new problems the modern era has created.
Right, because both term and whole life were fundamentally designed to protect your family against the financial devastation of you dying too soon.
Which used to be the main fear.
It was. But the defining crisis of 2026 is an entirely different financial risk. The risk of living a very, very long time.
Which brings us right back to that 85-year-old at the beginning of our deep dive. The longevity risk.
It's a massive issue.
The astronomical portfolio-destroying costs of healthcare, assisted living, and memory care. We are transitioning from the fear of an early death to the very real terror of living so long that you require years of continuous, highly expensive long-term care.
And we have to talk about how people traditionally tried to solve this and why it completely failed.
You're talking about standalone long-term care insurance, right? LTC.
Yes, standalone LTC insurance operates exactly like your auto or homeowner's insurance. You pay a premium every month, usually starting in your 50s or 60s.
Right.
If you eventually need assistance with the basic activities of daily living, eating, bathing, dressing, transferring, or if you develop severe cognitive impairment, the policy kicks in.
So it pays a daily or monthly benefit to cover those massive nursing home or in-home care bills.
Right. But there's a massive psychological hurdle here mentioned in our sources.
Oh, the fear of wasting money. Nobody wants to buy this product.
Nobody. Because if you are fortunate enough to live a long, healthy life, and you peacefully pass away in your sleep at age 90 without ever needing a day of nursing care.
All those years of expensive LTC premiums are completely gone.
Completely gone. You don't get a refund. Your family doesn't get a payout. You could easily pay $50,000 into a policy over 20 years and see absolutely zero financial return.
It feels like a lose-lose proposition. I mean, if you use the policy, it means your mind or body has failed. If you don't use the policy, you've essentially set tens of thousands of dollars on fire.
And beyond the psychology, the actual economics of standalone LTC have just been brutal. Insurance companies completely mispriced these policies in the 90s and 2000s.
They didn't realize how long people would live?
Exactly. People lived longer than expected, and the cost of care skyrocketed way faster than inflation. So insurance companies started hitting policyholders with massive, unexpected premium increases,
Oh, that's terrible. You'd be 75 years old on a fixed income, and suddenly your LTC premium doubles.
which forced so many seniors to drop the coverage they had been paying into for decades, right
Yeah.
before they actually needed it. It
Hmm.
was a completely broken system.
So the industry looked at this broken system. They looked at the psychological hurdle, the pricing instability, and the rapidly aging global population, and they engineered a solution.
They did.
Here's where it gets really interesting. This is where we see the massive rise of hybrid life insurance policies.
This is a major trend reshaping the industry.
It's the integration of coverage and care. Explain the genius of this hybrid model.
Well, the genius of the hybrid model is how it entirely neutralizes that fear of wasting money. A hybrid policy, often called a linked benefit policy, specifically merges traditional life insurance with long-term care benefits into one single contract.
Okay, so how does it neutralize the fear?
It contractually guarantees that the benefits of the policy will be paid out one way or another.
Let's break down the actual mechanics of that. Let's say I buy a hybrid policy today. How does the money flow?
Generally, these policies are funded with a single upfront lump sum, say $100,000, or through a guaranteed set of premiums over maybe 5 or 10 years.
Okay, so I pay my 100 grand. Then what?
In exchange for that funding, the insurance company provides a pool of money. Let's say your $100,000 premium instantly buys you a $300,000 life insurance death benefit.
Great, I've tripled my money for my heirs.
Exactly. But attached to that death benefit is a long-term care multiplier.
Okay, so I have a $300,000 bucket of money sitting there. What happens when I get older?
Scenario A. You suffer a stroke or develop dementia and require care. The policy allows you to accelerate that death benefit while you are still alive.
Accelerate it.
Yes. You can draw down, say, $6,000 a month from that $300,000 bucket to pay for your nursing facility or your in-home health aid.
Wow. So I am literally spending my own death benefit to keep myself out of poverty.
Precisely. You are using the life insurance while you're alive.
And if my care lasts for years and I drain the entire $300,000.
Then the policy has done its job. It protected your other investments, your 401k, your house, from being liquidated to pay for care.
That's huge.
But here is scenario B, the other side of the coin. What if you never need the care?
Right. What if I stay perfectly healthy until the very end? In a standalone policy, I lost everything.
Exactly. But in this hybrid policy, because you didn't drain the bucket for health care, your beneficiaries receive the full $300,000 death benefit tax-free when you pass away.
Oh, wow. So you use it for care or your family gets it as a legacy.
Either way, the money you put into the policy is going to execute its purpose.
Mm.
You have entirely removed the use it or lose it risk.
That is incredibly smart. And from what I understand, a lot of these policies even have a return of premium feature.
They do.
So if 10 years down the road I decide I just want my initial $100,000 back, I can walk away whole.
Exactly. It's incredibly clever from a behavioral finance perspective. It makes people willing to buy the protection.
But we have to look at the underlying risks and trade-offs, right?
Yes.
Because nothing in finance is actually free.
No, definitely not.
Yeah.
The underlying complexity of managing dual-purpose funds is the primary risk here. You are essentially pre-funding a massive pool of money that has to serve two very different masters.
The opportunity cost has to be significant. I mean, if I park $100,000 in a hybrid policy when I'm 60, that is $100,000. That is not sitting in the stock market compounding for 20 years.
Precisely. The internal rate of return on the death benefit of a hybrid policy is generally very low. You are mathematically trading maximum yield for dual-purpose utility and peace of mind.
Okay, so it's a defensive play, not an offensive play.
Exactly. And you also have to carefully understand the specific triggers that allow you to access the care funds.
It's not just a blank check.
No, it is not a blank check you can write just because you feel tired and want to live in maid.
Right.
There are strict medical criteria, usually the inability to perform 2 out of 6 activities of daily living, certified by a physician. The risk is not reading the fine print and misunderstanding exactly what qualifies as care.
Still, when you look at the macro picture, the high cost of healthcare and assisted living is the defining risk of a modern retirement.
It's the thing that bankrupts people.
You can save beautifully, invest perfectly, utilize the whole buy term and invest the difference, philosophy flawlessly. And 3 years of full-time memory care at $10,000 a month will completely dismantle that plan.
Completely.
Hybrid policies take that catastrophic tail risk off the table. They build a defensive moat around your portfolio.
Which, if you connect this to the listener's broader financial security, provides immense psychological freedom in retirement.
Because you aren't terrified of getting sick.
Exactly. If you know your healthcare tail risk is insured, you can actually spend and enjoy the rest of your portfolio without the constant lingering anxiety of a medical emergency bankrupting you.
Okay, so we've spent the first half of this deep dive building a fortress. We've talked about protecting your family's human capital with term. We've talked about protecting your portfolio from market volatility with whole life. And we've built a moat against healthcare costs with hybrid policies.
All very defensive strategies.
Right, we've got defense locked down. But what about offense? What if I'm not just trying to protect my assets, but actively trying to accelerate my wealth?
Inside a tax advantage wrapper.
Exactly. That shifts us into the engine room of the modern insurance industry. Indexed Universal Life, or IUL.
Oh, IUL. If there is a single product that epitomizes the sheer ambition, the complexity, and the controversy of the 2026 life insurance market, it is undoubtedly Indexed Universal Life.
It is everywhere right now. You can't spend 10 minutes on a financial forum without seeing a massive debate about IUL.
It completely dominates the marketing landscape.
So let's decode the mechanics of this engine. IUL is a form of permanent life insurance, right? It lasts your whole life, it has a death benefit, and it has a cash value component.
Correct.
But how that cash value grows is entirely different from the guaranteed bond-based dividends of whole life. With IUL, you earn returns based on the performance of an external stock market index, like the S&P 500.
That is the core mechanism.
Mm-hmm.
But we need to be incredibly precise here because this is where a lot of consumer confusion begins.
Okay, clarify it for us.
When you buy an IUL, your money is not actually invested in the stock market. You are not buying shares of Apple or Microsoft or an actual index fund.
Wait, if my money isn't in the market, how am I getting stock market returns?
Your premiums go into the insurance company's general account, just like with whole life. The insurance company guarantees your principal. But instead of just paying you a flat dividend, they use a portion of the yield from their massive bond portfolio to purchase call options on a stock market index.
Options. Okay, that sounds complicated.
An option is simply a financial derivative, a contract that gives the buyer the right to capture the upside of an asset without actually owning the underlying asset itself.
So they're betting on the market for me.
Sort of. The insurance company is essentially using the S&P 500 as a ruler to measure how much interest they owe you at the end of the year.
Okay, so if the S&P 500 goes up 15% in a given year, my cash value goes up based on that performance, giving me the potential for significantly higher returns than traditional whole life.
Exactly. You get to participate in the upward momentum of the broader economy.
But the truly revolutionary feature, the thing that salespeople highlight in neon lights, is the concept of floors. IUL features built-in protection against direct market losses.
This is the primary psychological hook for IUL. The most common floor is 0%.
0%, meaning I can't lose money.
Let's walk through a historical scenario to show how powerful this is. Let's look at the financial crisis of 2008.
A terrible year.
The S&P 500 dropped by roughly 38%. If your money was directly in a 401k or an IRA tied to the market, your retirement account was decimated. You lost 38% of your wealth in 12 months.
A devastating sequence of returns risk.
Exactly. But if you held an IUL policy with a 0% floor, your cash value did not drop by 38%. Your return for that catastrophic year was simply zero.
Wow.
You didn't gain a penny of interest, obviously, but you also didn't lose a single dollar of your principal or the previous gains you had already locked in. The floor acted as an absolute backstop.
Wait a minute, market gains with downside protection. That sounds way too good to be true.
It does, doesn't it?
I have to provide a reality check here. The insurance company is not running a charity. They aren't going to absorb all the downside risk of a market crash while letting me keep all the upside profit. There has to be a mathematical catch.
You are absolutely right to be highly skeptical, and there is a catch.
How do they afford to give me a 0% floor?
The catch is the cap. To afford the options that create your 0% floor, the insurance company places a performance cap on your upside gains. They limit how much of the market's growth you are allowed to capture.
So if the S&P 500 goes on an absolute tear and finishes the year up 25%,
If your policy has a cap of, say, 10%, your cash value is only credited with 10%.
even though the market did 25.
Even though the index went up 25, you hit your ceiling at 10. The insurance company keeps that remaining 15% spread.
Okay.
That is exactly how they generate the revenue required to provide you with the 0% floor during the terrible years. You are mathematically trading maximum upside potential for ultimate downside protection.
You clip off the highest highs to avoid the lowest lows,
Precisely.
which frankly is a perfectly reasonable financial trade-off for a conservative investor. It's a calculated risk mitigation strategy. But the problem and the massive risk outlined in our sources arises from the aggressive marketing tactics.
Yes, the marketing is where things get very murky.
IUL is heavily marketed, not just as life insurance, but as the ultimate tax-free retirement vehicle, making it highly appealing as an alternative to traditional retirement accounts.
This is where we have to connect the mechanics to the tax code. Under Section 7702 of the Internal Revenue Code, cash value inside a life insurance policy grows tax deferred. You don't pay capital gains taxes every year as it compounds.
It was a nice benefit.
But the magic trick that marketers love to sell is how you get the money out in retirement. You don't withdraw it, you borrow against it.
Right, because if you withdraw your gains, the IRS will tax them as income. But if you take a policy loan using your own cash value as collateral, the IRS does not consider debt to be taxable income.
Exactly. You are essentially taking a loan from the insurance company and pledging your life insurance cash value as security. Because it's a loan, it's tax-free.
Right.
And when you eventually die, the death benefit simply pays off the outstanding loan balance, and whatever is left goes to your heirs, also tax-free.
Right.
It is a closed-loop system of avoiding the IRS.
But wait, if I take a loan, I have to pay interest on that loan, right? The insurance company is going to charge me 5 or 6% interest for borrowing their money. How does that help me build wealth?
Okay, this introduces the concept of arbitrage, which is the engine within the engine.
Arbitrage.
Yes, in many IUL policies, you can take a participating loan. This means that even though you borrowed against your cash value, your entire cash value remains in the index account.
Wait, really? So it's still earning interest based on the S&P 500?
Yes. So if the insurance company charges you 5% interest on your loan, but the S&P 500 has a great year and credits your cash value with 8%.
I just made a positive 3% spread on money I already spent.
Exactly. You are earning money on borrowed money.
That is incredibly complex, and it relies on a massive assumption that the market will consistently return more than the loan interest rate.
Which is a huge assumption to make over 30 years.
If we hit a decade of stagnant market growth, and I'm earning 0% because of the floor, but I'm still being charged 5% loan interest every year, my policy could implode.
It could.
The loan could eventually exceed the cash value, the policy would lapse, and I would suddenly owe the IRS a massive tax bill on all those phantom gains.
You have just articulated the ultimate nightmare scenario of an IUL.
Yikes.
It is a highly leveraged, incredibly sensitive financial instrument. And beyond the market risk, there is the complex fee structure risk. You are paying for the cost of the underlying life insurance, you are paying administrative fees, and you are subject to the insurance company's discretion.
Discretion on what?
The caps. The company can, and often will, lower your cap rate in the future if the options market gets too expensive for them. You might buy a policy with a 12% cap today, and 5 years later the company lowers it to 8%.
Oh, wow. So it's a dynamic contract where the house can actually change the rules on you.
They absolutely can.
If we pull back and look at the bigger picture, it becomes very clear why IUL is so polarizing. It is a wildly powerful tool for tax-advantaged growth, but it requires immense care.
If we connect this to the bigger picture, IUL can be incredibly powerful, especially for high-income earners. Surgeons, tech executives, business owners, people seeking tax advantages who have already maxed out their 401ks and IRAs.
It's another place to shield wealth.
Exactly. But it requires proper, careful structuring by a fiduciary, and it requires active, ongoing management. It is not a set-it-and-forget-it tool. It should absolutely not outright replace traditional investments.
It's a specialized tool for a specific job.
Exactly.
Which leads me to a very practical question. We have just spent the last 45 minutes unpacking an incredibly dense financial ecosystem.
We covered a lot of ground.
We've talked about layering term policies, calculating whole life bond yields, triggering hybrid long term care benefits, and navigating IUL option caps, floors, and participating tax free arbitrage loans.
It's a mouthful.
It is. So if life insurance is no longer just a piece of paper in a drawer, but this dynamic, multi tiered, moving financial engine, how on earth is a normal person supposed to manage all this?
20 years ago, actively managing a portfolio of this complexity would have required a mountain of paperwork, continuous meetings with accountants, and a dedicated team of actuaries.
Right. It would be impossible for the average person.
But the answer to your question lies in the massive digital transformation that has fundamentally rewired the industry's infrastructure. Technology is the only reason these complex products are viable for the retail consumer today.
Let's look at the front end first, simply acquiring the coverage. The historical process of getting life insurance was honestly miserable.
It is awful.
You filled out a 50-page application, a stranger in scrubs showed up at your kitchen table to draw your blood and make you pee in a cup, and then you waited 2 months for a human underwriter to manually review your medical history. What's changing?
The adoption of AI-driven algorithmic underwriting. Instead of a blood test and a 2-month wait, the system pulls massive amounts of data in real time.
What kind of data?
It analyzes your electronic health records, your prescription drug history, your motor vehicle reports, and even your digital footprint to assess your mortality risk almost instantaneously.
So it's creating personalized pricing based on data analytics.
Exactly. Approval times are dropping from 8 weeks to literally 8 seconds for many applicants.
Which entirely removes the friction and the intimidation of the process. You can secure $500,000 of term coverage while sitting in an airport terminal.
Exactly.
But what about the management side? Because once I have this complex portfolio of term, hybrid, and IUL policies, how do I keep track of it all without losing my mind?
Well, the industry realized that to sell dynamic tools, they had to build dynamic dashboards. They invested billions into online platforms to simplify policy management.
Okay, so it's all online.
The expectation of the modern consumer is that their life insurance should be as intuitive and transparent as their daily banking app or their Robinhood account.
I'm picturing logging into a single app on my phone. On one screen, I can see my term protection level. On another tab, I can see exactly how close my S&P 500 index is to hitting its cap for the month in my IUL.
Yes, exactly like that.
I can adjust my premium payments with a slider. I can monitor the available balance in my long-term care bucket. The software completely abstracts the underlying mathematical complexity and just gives me the levers to steer the ship.
Precisely. The dashboard hides the engine. But the transformation doesn't stop with just a better user interface. If we look ahead to the future, looking at where the 2026 trends are heading next, the momentum is pushing toward unprecedented proactive integration.
Historically, life insurance was entirely reactive. You died, they paid. Now, the industry is pivoting to preventative intervention.
Yes. It looks like greater integration with healthcare and wellness programs. Imagine a modular life insurance policy that connects directly to your wearable biometric devices.
Like your Apple Watch or a continuous glucose monitor.
Exactly. The policy actively analyzes your daily activity, your resting heart rate, your sleep cycles. If you hit specific health milestones, if you lower your blood pressure, if you maintain a consistent exercise regimen, the algorithm dynamically lowers your mortality risk profile.
And it automatically reduces your monthly premiums in real time.
Yes.
Wow. So the insurance company is actively financially incentivizing you to stay alive. It aligns their profit motive with your longevity. You live longer, they collect premiums longer, and delay the payout, so they share the economic surplus with you via discounts.
That is a brilliant alignment of incentives, isn't it?
It's amazing.
We are also seeing a shift toward more customizable, fully modular policies. Instead of buying a rigid prepackaged whole life or IUL policy, you will essentially build your own custom financial stack on a digital platform.
Like building blocks.
Exactly. You select a core death benefit module.
Yeah.
5 years later, when you have kids, you digitally snap on a term rider module to increase protection. 10 years after that, as your wealth grows, you snap on an index-linked accumulation module for tax-free growth.
And then later in life, you snap on a long-term care acceleration module. Your policy basically breathes and scales dynamically as your life circumstances evolve.
And we're also seeing the continued blending of insurance with alternative asset management, where insurers are using alternative investments to boost yields.
So what does this all mean? When we take a massive step back and look at this entire landscape, the foundation of term and whole life, the behavioral genius of hybrid healthcare solutions, the complex wealth engines of IUL, and the seamless digital interfaces that make it all manageable. What is the ultimate impact of this evolution on the consumer?
The final synthesis here is that the modern consumer has an unprecedented amount of power and an unprecedented number of options. This new era of life insurance offers tools to build generational wealth, generate tax-efficient income, and build ironclad moats against catastrophic health costs in ways that simply weren't accessible a generation ago.
Right?
But, and this is the absolute most critical point, greater choice comes with greater responsibility. Understanding how these products work and how they fit into your overall financial plan is essential.
Because it is very, very easy to buy a phenomenally engineered tool, but use it for the completely wrong job.
Exactly. You don't use a highly complex IUL with a 10% cap and a participating loan structure if your only actual goal is to make sure your spouse can pay off the mortgage if you get hit by a bus.
Right. Complexity for the sake of complexity is a massive financial mistake.
Exactly. The key is prioritizing proper planning over buying into aggressive marketing. For many people, simpler options like a cheap, simple term policy combined with a standard index fund may still be the absolute best choice. The key is ensuring that the specific mechanics of the tool perfectly match the actual requirements of the job.
That is the perfect distillation of everything we've covered today. Match the tool to the task. Because life insurance is no longer just about protection, it is becoming a hybrid financial product combining insurance, investing, retirement, and healthcare.
It's a whole new world.
Which brings us to our call to action for you, the listener. Because life insurance is clearly no longer just a static, set it and forget it piece of paper. It is a highly dynamic, vital component of your broader financial architecture.
So we encourage you to conduct an audit.
Yeah. Open up that proverbial or literal filing cabinet. Look closely at the tools you currently possess. Do they match your actual realistic goals for the future?
Are you genuinely prepared for the financial reality of longevity in healthcare? Are you properly anchored against the sequence of returns risk in a volatile market?
And as you reflect on the architecture of your own portfolio, we want to leave you with one final, lingering question to ponder. A thought that extrapolates on everything we've unpacked today.
We have seen how life insurance is rapidly, aggressively blending asset management, tax-free retirement income, and critical healthcare coverage into highly personalized, digitally integrated, app-based modular policies.
Right.
If that trend continues at this velocity,
Yeah.
how long until the dividing line between your wealth management bank, your doctor, and your life insurance provider disappears entirely?
That is a wild and highly probable thought. The ultimate institutional convergence.
Right.
We have truly moved from the dusty stack of morbid paperwork hidden in a drawer to a fully integrated, proactive engine designed to manage both your life and your legacy. It really is a fascinating new era.
It certainly is.
Thank you for diving deep with us today. We'll see you next time.